Hello and welcome to the Business Standard Morning Show. I'm Debarg Sanyal and here are the top stories for the day. Bike taxis have hit yet another roadblock, this time in Delhi. The Delhi Transport Department on Monday became the latest state government body to put a stop to bike taxi services. But why are state governments disallowing these two-wheeler cab services? We offer you a roadmap. On Monday, Delhi became the latest state to ban bike taxi services after Meghalaya, Karnataka, and Maharashtra. The Delhi Transport Department issued a public notice to mobility players such as Uber, Ola, and Rapido to immediately stop their operations. The ban is rooted in the Motor Vehicles Act of 1988, which prevents vehicles having a non-transport or private registration number to carry out commercial operations. There is no provision for two-wheelers to seek a license for registering and operating as a bike taxi. Earlier this month, the Supreme Court had also cited the same act and refused to grant relief to bike taxi aggregator Rapido against the Maharashtra government's refusal to grant license. In December 2022, the Karnataka State Transport Authority too had refused to renew licenses of Uber and Ola.
The reason why bike taxis are under so much of a scandal recently is because there is no proper licensing in place. Bike taxis that have been plying have not been licensed as what we call as transport vehicles. So transport vehicles are the ones that are allowed to actually carry passengers and goods. But private vehicles which don't have that license cannot do so.
Commercial taxes are higher than private vehicle taxes. So, because the yellow boards, as we call them, pay a greater tax than private vehicles, most state governments would like to earn greater revenue. The second reason is that as a kind of a safety valve, getting everybody regulated and having the address and contact numbers of every detail who's there. The state governments feel that it is important to be able to control and regulate this.
The Delhi Transport Department said any violation will result in a fine of Rs 5,000 in the first instance. For the second offence, there is imprisonment, which may extend to 1 year and attract a fine of up to 10,000 rupees. The culprit's vehicle too will be impounded. Bike taxis gained popularity during and after the pandemic when public transport services like metro and buses were running with limited seating capacity. They are preferred by commuters because of their cheaper fares. According to the existing Delhi government regulations, a taxi service must have a driver and at least one passenger. This rule covers four-wheeler cabs, auto rickshaws, and e-rickshaws, but excludes bikes. A cab service should have a registration mark, a yellow number plate, a PSV badge which is issued after police verification, and drivers are supposed to undergo behavioral sessions. Moreover, women's safety is of utmost importance in such services and panic button provisions are mandatory. Authorities say these provisions will be difficult to apply to two-wheeler cabs.
I think here the panic button is available on the app. Even for four-wheelers, it's a part of the app. So there's nothing preventing a two-wheeler app. I think in some cases it's the same app. So, the panic button is actually built in.
If you look at the central government guidelines, there are very stringent measures to be followed by aggregators. Getting off a license by an aggregator is subject to them training their drivers, providing, women-only services, providing certain safety measures, etc. And, it is absolutely open for an aggregator to integrate that through their apps. But, at the same time, in order for creating a safe environment and having trained skilled drivers with the apps have to take into account these requirements.
Joshi also believes states must therefore come up with comprehensive policies for setting up aggregator services.
The bike taxi services we're looking at are supposed to be done through aggregator type services. However, no aggregator licenses have been issued because the states themselves have not come out with the policies for setting up these aggregator systems within the states. But as the Bombay High Court said that if you're complaining that there's no policy, it's really within your control and within your remit to actually set up that policy.
Chinoy says that instead of different guidelines for each state, there should be a national regulatory model.
Fractional ownership and fractional loads and fractional passengers, etc., are going to be a thing of the future. National level, if they can come out from model act or a model regulatory framework, light touch regulatory framework, covering things like registration, safety, insurance, and then the states actually implementing it. Because if each state starts doing it independently, then you might have a spaghetti bowl of different type of regulations across different states.
Experts are clear, therefore, that banning two-wheeler cab services is not the answer. Instead, both the aggregators as well as the government authorities must evolve towards an ecosystem of fractional services. And a national regulatory model seems to be the need of the hour. In a recent merger and acquisition deal, Metro Cash and Carry was acquired by Reliance Retail at Rs 2,800 crore. Arvind Mediratta, MD and CEO of Metro Cash and Carry, which is the Indian arm of German retail chain Metro AG, spoke to Nivedita Mukherjee about the deal, future of the Indian retail market, and more. She began by asking him about the move from a multinational to an Indian conglomerate.
Hello, Mr. Mediratta. Welcome to the Business Standard Show.
Good afternoon, Nivedita, and thank you for hosting me on this platform.
You have steered the Indian business of German chain Metro AG for several years. And now it's over to Reliance. What is the transition like?
So I will say that we are still in the middle of the transition. The deal has not concluded finally. We are waiting for some regulatory approvals before the deal will be concluded. Yes, a definitive SPA has been signed. It was signed in December. So we hope that the deal will conclude by end of this Indian financial year, which is by March 31st.
But so far, what is your impression, from a multinational company to a completely Indian conglomerate?
So I will say there are several things which I want to highlight. So first of all, we believe that the B2B model that Metro is basically focused on has a lot of opportunity in the Indian market, right? And to expand our business from 31 stores to probably 100 plus stores, we need investments, we need CapEx to be able to expand our business aggressively, both the physical footprint as well as the digital footprint, right? And we believe in the form of Reliance, we have a partner who has a very robust understanding of the Indian market. It's a core market for them. They have the deep pockets required to invest in this business to grow it and grow it multiple times. And I will also say that there are a lot of synergies which are possible by becoming part of Reliance Group. We will get scale, which should help us negotiate better terms of trade with suppliers. They are very strong in technology with the geo platforms that they have, right? So we'll benefit from that. And of course, if you combine with the capability and the understanding of B2B space that we have over the last almost 20 years in India, Combine that with the Reliance's knowledge of the Indian market, we have a very, very powerful combination.
Any indication on what will it be for the people of the company? Will there be any change there in strategy?
I cannot answer these questions on the future strategy and the future organizational plans, but I can tell you that, from our conversations that we have had with Reliance, they're very clear that Metro has very strong capability in this space, and they are very keen to retain all the talent that we have. And this is a message that we have been sharing with all the people in the head office as well as the stores, that we have a profitable business. Nobody else in India in B2B space has been able to develop and run a profitable business. And people have to be very, very reassured about their future.
Like you pointed out, Metro Cash and Carry was doing well, and there is a huge promise in this cash and carry segment. So, what went wrong? Why was the India business sold in the first place?
So, I will say it's wrong to use the words what went wrong. Everything went right. So, let me explain to you. So, we have been focused on B2B in India from day one, since 2003 when we set up the first store in Bangalore. It took us almost 15, 16 years to turn the business profitable. So we were profitable in 2018. We became profitable for the first time in 2018. And we have been profitable since then, despite the competition increasing manifold in this space, right? Of course, if you look at any business in the life cycle of that business, once you have established a very robust model, there is time for expansion, right? So we believe that $1 billion revenues, 31 stores is not doing justice to the opportunity in the B2B space. As is logical, once you have reached a certain base of $1 billion, very strong customer base, very strong presence in certain geographies like Karnataka, AP, Telangana, UP, etc., we believe that we can do a lot more. The market itself is $600, $700 billion in terms of size. So we can be 10 times bigger, but to be 10 times bigger, there is money required for investments. Now, we have had several rounds of discussions with the parent organization. We also put together a blueprint from what is possible in India. If the investments come in, what is the quantum of those investments that we need over the next 4-5 years period? And after that, the company decided that given the Ukrainian-Russia war, and both are critical markets for us, and looking at the entire political landscape, Asian market, they are not very focused on Asia. They exited China about a couple of years ago. We exited Vietnam probably 8-9 years ago. So they decided to focus their resources on Europe. And that was a time when we said, okay, then let's look at who are the potential partners available in India. And of course, Reliance emerged as a front runner.
Do you think there have been regulatory challenges on the way and that things could have been better in India?
Yes, I think there are regulatory challenges, and it's not at the center level. I think sometimes it's about interpretation of the policy. It varies from one official to another at the state, and I will say even at the city level. So we have to sometimes educate the government officials that please read the FDI policy and educate yourself instead of coming in harassing us.
Staying on the regulatory theme, what are your thoughts on FDI in multi-brand retail? I know you in Metro Cash and Carry, you were not interested in that space. But as somebody from the industry, what do you think? Do you think there should be greater clarity from the government on, what really should be the policy on FDI?
Yeah, to my mind, it's a very good question. I personally believe that the government should come out with clarity on FDI in multi-brand retail, right? If multi-brand retail is allowed, I think it's going to be good for the end customers, right? Because you'll have foreign players who don't have to be bothered by, different interpretation of the FDI policy by different government officials across states. If there is one clear policy and we allow multi-brand retail, a lot of the problems can disappear.
Finally, I want to ask you about the mood in the retail sector. What is the consumption mood like, really? What are the numbers telling you? What are the trends telling you?
See, from what we understand right now, there is some softness in demand, especially in starting from January. There has been some softness in demand. I was talking to some people even before this call. So yes, there is some softness in demand. People are not opening up their purse strings as liberally as we would like them to do. I think the layoffs which have happened in the IT sector have played some role. So people are fearful about their future, right? There is also the cost of inflation is running high, of course, and that is also in a way playing spoil sport because people are focusing on essentials and discretionary spend has been cut. But I'm very optimistic that overall the India growth story is very much intact. So I believe that maybe in the next 5-6 months, the demand will again pick up, and this whole negativity because of layoffs and all will disappear.
Thank you. Thank you so much for speaking to Business Standard.
Global and domestic developments have kept the market sentiment in check so far this calendar year. The returns from benchmark Sensex and Nifty have been nearly negligible. So, what should investors do? Is it a time to remain a fence sitter? Or is there any investment strategy that one can adopt in this range bound market? Puneet Wadhwa gauges the market mood in our next report, highlighting the top sectors and stocks recommended by analysts.
It has been a nervous start for the markets to the calendar year 2023. While the Sensex has been range-bound between 59,000 to 63,000 over the past 3 months, the Nifty has oscillated between 17,600 and 18,800 during this period. Both benchmarks have been underperformers as compared to their global peers thus far in 2023. Analysts believe this muted performance comes after a good run in 2022 and is partly attributed due to the fear of a global recession and the ensuing central bank policy action. Moreover, the developments with the Adani Group back home have also kept the mood in check. Expensive valuation, according to Siddharth Bamre of Reliance Broking, is another headwind.
Nifty, in fact, if you look for investors, this market is in range since September 2021. And for positional traders who have time horizon of 15 days to 1 month, this market is in a range since last 5 months. And even for short-term traders, last 1.5 months, barring that 1 day, market is hovering around this 18,000 levels. And there are specific reasons for that. Firstly, interest rate is the main concern which people have, and now with fresh data coming of US inflation and even the job data, which is clearly hinting towards that Fed would continue to hike its interest rates, and that would make equity less attractive if bond yields are higher, and hence we are seeing that markets are stuck in range. Though the problem of inflation and interest rate is not so much related to us in India, and that's the reason 2-3 months back we have seen our market performing very well. Now valuations are bit expensive, and they were much more expensive a couple of months back. Now we have seen bit of correction. If you look at the earnings season which has crossed us or is crossing, we haven't seen any major positive triggers. So yes, there is still gap between the way market is and where the valuations are. We might see some more time correction. And mind you, if the inflation numbers and the inflation data comes this way from US, then we may further see some correction. But as of now, the best case scenario for us is that this time consolidation for all the participants might continue for some more time.
In a recent note, analysts at Elara Capital noted that FII's country rotation to China and ongoing liquidity withdrawal too pose headwinds to the markets. However, the sustained strength in earnings, they said, could provide downside protection to the markets in the near term, keeping them range-bound for some more quarters. Against this backdrop, what could be a good investment strategy that one can adopt in this range-bound market? Bamre of Reliance suggests this to investors.
Such kind of consolidation, it is always that you be sector specific or stock specific, and we have certain sectors which have done really well, and we believe that they might continue to do well because the earnings support is also there. So firstly, if you look at FMCG space, We have ITC, Britannia under our coverage who have done well, and we have recently upgraded their targets. So these are few names in FMCG space which will do well. Even from cement space, we are liking Ultratech Cement and Dalmia Bharat. And cement, apart from capacity expansion, we are now seeing that input cost pressures are coming down, and this space can continue to do well. The other space which we are liking is auto. It's not a defensive space, but then the kind of monthly numbers which you're seeing coming from, especially four-wheeler segment, is pretty encouraging. Within this space, the market leader, Maruti, which has now series of products getting launched in after hiatus of 4-5 years, will see its underperformance of last 5 years go.
ICICI Securities meanwhile suggests investors use corrections to buy stocks of companies that have lean balance sheets, are capital efficient, and possess growth longevity. It says Nifty earnings are seen growing at a CAGR of around 15% over FY22-25. We retain our Nifty target at 21,500, valuing the index at 21 times PE on FY24-25 average Nifty EPS of 1,020 rupees. Therefore, adopting a stock-specific approach seems to be the ideal strategy in these market conditions as per analysts. On Wednesday, the markets are likely to remain range-bound amid the lack of any significant triggers.
Like equities and mutual funds, savings made under EPF scheme also offer good returns due to over 8% interest rate. An amendment made in 2014 and ratified by the Supreme Court in November last year has made it even more attractive. Raghav Agarwal's report reveals how.
Retirement Fund Body EPFO has come out with a set of instructions and procedures to allow workers and their employers to jointly apply for a higher pension under the Employees' Pension Scheme. Under the new scheme, employees with their employers can exercise a joint option for higher pension contributions. The subscribers of EPFO are allowed to go beyond the pensionable salary capped at Rs 15,000 per month and add more money during their work life towards pension. As of now, the employers deduct 8.33% of the employee's pensionable salary towards pension. They also contribute an equal amount to the EPS. But post-amendments, the employer and the employees can jointly request the EPFO to deduct 8.33% from a higher monthly pensionable salary. Let us try to understand with an example. Suppose your basic salary is 50,000 rupees. 12% of it, or 6,000 rupees, goes towards Provident Fund contribution. Out of this, 8.33% of the cap, rupees 15,000, which is 1,250 rupees, goes towards pension. Rest 4,750 rupees goes towards EPF. Now, under the new regime, the cap of 15,000 rupees has been removed and 8.33% can be calculated on the entire 50,000 rupees. So, the pension contribution comes out to be 4,165 rupees. The EPF contribution will fall to 1,835 rupees. So, if you opt for this, you might get a higher pension, but your EPF contribution will fall. A joint option form will be used for the application. A URL or a digital facility will be notified shortly, and the two parties can fill the form and submit it there. The application will then be digitally logged and a receipt number will be provided to the applicant. The in charge of the Regional Provident Fund Office will examine the application and inform the applicant about the decision through email, post, and SMS. The applicants will be allowed to register their complaints on EPFO's grievance portal. Details like the mode of contribution and computation of pension are yet to be announced.
I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
As of now, it is not clear how the higher contribution will be funded. EPFO will come out with another circular on this soon. That's all for today. For more news and analysis, please log into business-standard.com. Thank you.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.